Afternoon. Today I'll be talking about a fundamental concept in accounting, which is depreciation. My name is Salma Siddique, and by the end of this session, you'll have a clear understanding of what depreciation is, why it's important, the different methods used to calculate, and how it's treated in financial statements. Let's start. So, what is this depreciation? Depreciation is the process of allocating the cost of a tangible fixed asset over its useful life. In simpler terms, when a company buys something like machinery, vehicles, or furniture, that item loses value over time. Depreciation accounts for this loss in value. This loss can happen due to usage, wear and tear, the passage of time, or even technological changes. For example, a computer may still work after 5 years, but it's likely to have far less value than why it was new and newer model and software. It reflects how asset loses value due to usage time and technological changes. This depreciation concept helps ensure the financial statement and shows a true and fair view of the company asset. So, why is this depreciation important? Now, you might ask, why does this matter? Depreciation is essential for several reasons. It ensures that financial statement presents a fair and accurate picture of a company's asset value. It helps a business plan for the future, particularly asset maintenance or replacement. It affects profitability and taxation. For instance, the more depreciation you record, the lower your taxable income might be. So, the importance of this depreciation. So, as I said in the first slide, over the time, there's physical deterioration, there's obsolescence, there's time passage. It wears and tears as you use it. The technology updates can make asset outdated. Even unused asset loses value over time due to aging. Now, not all assets depreciate. Assets like vehicle, machinery, furniture, and buildings do depreciate because they wear out over time and they become outdated. However, assets like land, antique, or artwork usually do not. They often increase on value over time. For example, for land, once you buy it, the time goes by, the value appreciates, it increases the value, the demand increases. Therefore, these three terms, they appreciate over time, they do not depreciate. Now, depreciation and matching concept. Depreciation also supports the matching principle in accounting. This means we match the expenses with the revenue and they help generate. Without depreciation, a business might report very high profit in the first year of using an expensive asset and artificially low profit in the following year. Depreciation spreads the cost evenly and gains a truer picture on financial performance. So let's have a look at the key terms. There's residual value, there's useful life, there's depreciable amount. Residual value is the estimated value of an asset at the end of its useful life. And useful life is how long an asset is expected to be productive. Depreciable amount is the cost of the asset minus its residual value. These three terms are the foundation for calculating a depreciation. Now, there are various methods of depreciation: straight line, reducing balance method, revaluation, and units of production. I will go step by step for each depreciation method and I'll give examples as well. So, for this straight line method, it is equally depreciated each year and it's very simple and it's commonly used. It's the most common method that is used in our companies. So how do we calculate this straight line? Well, the formula is very simple. It's cost minus residual life divided by useful life. So as we discussed, the residual value is the estimated value of an asset at the end of its useful life. Now let's look at the example. The cost of the asset is $10,000 and the residual value is $1,000 and the estimated useful life is 5 years. So to calculate the depreciation per year, what we do is we subtract as per the formula cost minus residual value, which is 10,000 minus $1,000 divided by its useful life, which is 5, and its depreciation over the 5 years, it is allocated evenly 1,800 per year. Now let's look at reducing balance method. It applies a fixed percentage to the asset book value, means higher depreciation in the early years and less as time goes on. Higher depreciation in early years, it means that this method applies a fixed percentage of depreciation to the asset's net book value at the beginning of each year. Now your question might be, what is this net book value? So net book value is assets original cost minus accumulated depreciation. It represents the asset current value in the books after accounting for depreciation to date. NBV decreases each year as more depreciation is charged. So how do we calculate this reducing balance method? Let's look at the example. This method results in higher expenses in early years and lower in later years, ideal for assets that loses value quickly, for example electronic or vehicles. So in the asset cost is $10,000 and the depreciation rate is 20%. So in year 1 we're taking $10,000 and we're multiplying it with 20%. So 10,000 minus $2,000 is $8,000. In the year 2, we will take this net book value. So the net book value is basically minusing the cost minus the depreciation, which is the NBV. In year 2, we take this NBV, we multiply it with the depreciation rate, and we find the second year NBV, which is $8,000 into 20%, which is $1,600. We deduct $8,000 minus $1,600 and we get $6,400. Now similarly in year 3, we take the year 2 NBV, which is $6,400. We multiply it with depreciation rate, which is 20%. We get $1,280. Now we deduct 6,400 minus 1,280 and we find 5,120 for year 3. This method, as I said before, suits asset that loses value very quickly. So I have done this example again over here, 10,000 into 20%, which results in $2,000. Now let's look at another example, which is revaluation method. So what is this revaluation method? It involves adjusting asset value based on current market value. For instance, if a building is initially worth $100,000, which is later valued at $1,020, depreciation would be based on the updated value. So the revaluation of asset is done periodically. Now let's look at the final method of depreciation, which is units of production. It is directly linked to depreciation based on the usage. Example, machine hours or units produced. So if a machine is expected to produce 100,000 units and produces 10,000 in a year, that year depreciates is 10% of the depreciable amount. This is ideal for assets where depends on output, not time. So how do we treat these depreciations? Where does it appear in accounting? Well, in the income statement, depreciation is recorded as an operating expense, and on the balance sheet it reduces the asset amount, carrying amount through accumulated depreciation. Depreciation basically goes in both income statement and on the balance sheet. In balance sheet, it reduces the asset book value through an account called accumulated depreciation. This accumulated amount grows each year and reflects the total depreciation charged to date. Proper depreciation ensures compliance with accounting standards like IFRS and GAAP. And accumulated depreciation is treated as contra asset account, which is offset of original asset cost. Now the disposable of asset. What is this disposable of asset? It's basically selling your asset or scrapping the asset, and you're recording the gain or loss you're receiving by disposing the asset. When a company disposes an asset, it may sell or scrap it. The book value is compared with the sale proceed. If sold for more than book value, it's a gain. If sold for loss, it's a loss. This result is recorded in the income statement. Now let's look at the journal entries for depreciation. The typical journal entry for recording depreciation is the depreciation expense, which is in income statement. It is basically expenses are basically treated as debit. So the depreciation expense always goes to debit segment, and the accumulated depreciation goes to credit. This ensures that the expense is recognized and the asset value is adjusted properly. Now there are common errors in depreciation. Some common mistakes in depreciation includes not reviewing the asset useful life periodically, poor estimation of residual value, applying the same method to all assets without considering their specific nature or usage. This error can distort financial statements and decision makings. Now, how should this depreciation be treated? Well, the depreciation isn't just about numbers. It's about reflecting economic reality. Choosing the right method and applying it correctly ensures financial transparency and helps business plan wisely. Remember, each method serves a different purpose, and good accounting means choosing the method that best fits the asset and the company goals. A well-managed depreciation policy supports accurate reporting and smart financial decision. Well, that is it. Please let me know if you have enjoyed my fundamental concept in depreciation. And that brings us to the end of our session. Thank you very much for listening and for giving me time. I hope you feel more confident in understanding depreciation and its role in accounting. And I'm happy if you have any questions in accounting depreciation chapter, and please let me know in the comment segment. Thank you. Have a great day. Bye bye.